Good evening, everyone. Thank you for joining us. We're just going to give it a minute or so just to wait for numbers to steady off, and then we'll get started. Just give it another moment or so. We've just hit 6:30. Just give it another moment and then we'll get started. Okay, I think we have everyone who is going to join us. So good evening and thank you for joining us this evening on this webinar. I am joined this evening by George Crow, who works alongside myself within the medical team at Larking, Gowen Accountants. My name's Louise. I'm one of the partners leading the medical team. And we're also joined by Simon Dickerson, who is independent financial advisor from Medical Financial Services. So this evening we are providing you an update on NHS pensions and the annual allowance. So this is a session covering off all scheme members other than GP practitioners, as there are slightly different methods of how the pension is calculated. So just a brief agenda of what we're going to cover. So we'll touch on the annual allowance. Hopefully you're all aware what it means. It's been around for a little while now. So just a very brief recap of the annual allowance and the taper. We're going to look at a couple of the impacts of inflation, because we're currently in a period where inflation has been rising quite rapidly, and that does have an impact on your pension benefits. We'll also discuss some of the other areas of risk where you may have more chance of excess growth and therefore a tax charge. Finally, from our side, we'll talk about what options you have. And then Simon will cover it from more of a financial services, looking at the impact of scheme pays in financial terms, and some of the implications of opting out of the scheme. So I will hand over to George, who will kick things off.
Thank you very much, Louise. Welcome all, and thank you for joining us. So, as Louise said, there's a few topics which we're just going to run through. I will try to keep it fairly brief, acting as Simon's warm-up app today. So we'll start off with a brief recap of the annual allowance. So the annual allowance, what is it? Well, firstly, it's a limit of £40,000 in terms of how much your pension can grow by within a year. If you exceed the available annual allowance and the available brought forward unused annual allowances, then you would be subject to a tax charge. That limit of £40,000 can be reduced down to as low as £4,000, and that only happens if your taxable income exceeds £200,000. One of the common misconceptions that we see regarding the NHS pension scheme is that my pension growth is what I've contributed to the scheme. That's not true. The NHS pension scheme is a defined benefit scheme, not a defined contribution scheme. The difference is that your pension doesn't grow by how much you contribute. It's based on your pay and your earnings, and therefore the pension input amount is calculated in a much more complex manner. So pension growth doesn't link and correlate directly to how much the contributions you've paid during the year. As I mentioned, if you exceed the available allowance, and that includes the limit in the year, so that can be £40,000, and indeed any unused allowances from the previous 3 years, then any excess is then taxed at your marginal rate of tax, be that 40% or 45%. You then have an option, if you do suffer a tax charge, that you can either pay that tax personally as part of your self-assessment tax return, and that will be payable 31st of January following the end of the tax year, or alternatively, elect for the NHS pension scheme to pay the tax charge on your behalf, and that would come as that would class as a debit to your pension, which would be reclaimed upon retirement by NHS pensions. They reclaim that by reducing your pension benefits, and they claw back the amount that they've paid plus interest. So it's a decision that you would need to seek financial advice on, and that's why we've got Simon with us today. Next slide, please, Louise. So where can issues arise? There's quite a few areas where issues can arise. An increasing pensionable salary links into quite a few of these. So clinical excellence awards, you've got local and national clinical excellence awards. Local clinical excellence awards at the moment, new ones are not pensionable. National clinical excellence awards are. So if you are in receipt of a new national clinical excellence award, that would serve to increase your pensionable pay, which in turn increases your pension and contributes potentially quite a significant amount of pension inputs during that year. Outside earnings, it's not a particularly relevant one at the moment, simply because the taxable income has to exceed £200,000. If your outside earnings do tip you over that £200,000, then it does have an impact in terms of reducing the available allowances that you've got, but it doesn't actually impact on the pension growth. So monitoring your outside earnings and potentially looking at ways that you can bring your outside earnings or bring your taxable income down to under £200,000 is something that you might want to speak to us or a financial advisor about in terms of how you can achieve that without potentially incurring significant tax bills. Added years contracts, so these are only applicable for members of the 1995 scheme and those that are already in place. So added years contracts increase the service. Your pension within the 1995 scheme is based on your service out of an 80-year fraction. So your pension will pay multiplied by your service out of 80 years gives you your pension. An added years contract gives you more service and therefore increases the pension, gives you a greater amount of growth on an annual basis. Private pension contributions, so your annual allowances across all of your pension, that's your NHS pension, and that can be your 1995 and 2015 schemes, and also any private pension contributions. So if your total pension input amounts, the growth in the NHS pension schemes plus any private pension contributions exceeds the available allowance, then you would suffer a tax charge. One thing on here that is becoming more and more relevant is the cessation of salary sacrifice arrangements. A lot of people have set these up with a view to buying cars, electric cars, for example, as a way of spreading the cost and not having to fork out large amounts as a one-off payment. A salary sacrifice arrangement serves to reduce your taxable and pensionable pay. What that means is obviously you benefit from the saved tax, national insurance, and indeed pension contributions. The impact of that when you stop the salary sacrifice is that your pensionable pay increases quite significantly potentially. The 1995 scheme and the 2008 scheme are final salary schemes. So what they do is linked to your best pensionable pay out of the last 3 years. If you stop the salary sacrifice arrangement and your pay increases quite significantly, that can lead to quite horrendous amounts of growth in terms of the amounts of pension input amount, and therefore can lead to quite significant tax charges. So if you are approaching the end of the salary sacrifice arrangement, then I would strongly recommend that you speak to a professional about that and get some advice in terms of how you can potentially mitigate the effect of the salary sacrifice arrangement ending. The one that we're here and going to focus on the majority of the course today is increasing inflation. So on the next slide, we have an example, or we're going to go through a worked example of how increasing inflation does impact on your pension. So the NHS pension scheme is linked to inflation. What that means is your pension benefits grow in line with the current level of inflation. Your pension benefits are allowed to grow by CPI. The allowed growth is the previous year's CPI. So we've listed a few figures there. September 2020, 0.5%, September 2021, 3.1%, and May 2022, 9.1%. Where you're an active member of the NHS pension scheme, your pension benefits within the 2015 scheme also receive an additional 1.5% uplift on top of inflation. This is called the dynamisation factor. So, for example, the September 2021 3.1% becomes an uplift of 4.6%. When, as it says there, when calculating your pension inputs, the opening values, so previous year's closing values, are uplifted by CPI. That CPI figure that they are uplifted by is the previous year's CPI, but the in-year pension growth is the current year CPI. So in periods where inflation is increasing, the actual growth in your pension, your existing pension benefits, already exceeds potentially the previous year's CPI. So to put that into effect, if we go over to the next slide, Louise, we'll run through a quick example. So this relates to 2015 scheme benefits because CPI doesn't have an impact on your 1995 scheme benefits. It does have a slight impact on your 2008 scheme benefits because your pensionable pay is uplifted by pension increase factors to bring it up to a current year rate. So the higher the pension increase factors, obviously the higher the uplift in the pension. The pensionable pay, the reckonable pay of the best 3 years is. So it does have a slight impact, but the main impact is within the 2015 scheme. So where the McLeod remedy has happened, i.e. that 7-year period between 1st of April 2015 and 31st of March 2022 31st of March 2022 has moved back into your legacy schemes. The first year that you would have within the 2015 scheme is 2022-2023. What we've assumed here is that we've got an individual with pensionable pay in 2021-22 of £85,000 and in 2022-23 of £90,000. That individual has 20 years worth of service within the 1995 scheme, and as you can see, the change in pensionable pay, the increase from £85,000 to £90,000, has given them a pension input amount within the 1995 scheme of £10,898. Like I say, that's not linked to inflation, that's linked to an increase in pay. So where we're potentially looking at significant pay increases, which could in future be linked to inflation, if we're saying that the NHS is going to get a pay rise which is in line with inflation, actually that could have quite a significant impact for the 1995 scheme because your pensionable pay will increase and so too will your pension benefits within the 1995 scheme as a result. The 2015 scheme is pensionable, or your pensionable pay goes into that and you build up a pot. So the pot will continue to grow and continue to roll up year on year in line with inflation plus that 1.5%. So in 2022-23, based on a pensionable pay of £90,000, your pension input amount is £29,455, which gives a total pension input amount for that year of £40,353. That breaches your available £40,000 allowance. So depending on whether you've got any unused allowances from the previous 3 years, there's potential that there would be a tax charge. If we instead said that inflation was at 3%, you can see how that impacts on the calculations. It reduces the total growth by about £2,000. So that would actually bring you under the full £40,000 allowance. That is obviously assuming that you have taxable income under £200,000 and therefore wouldn't have a tax charge because your available allowance would cover that growth in that year. Next slide, please, Louise. So what happens if inflation again remains at 9% for 2023-24? And then again, pensionable pay increases to 92,500. So there's a small increase in pensionable pay. Because the previous year's CPI is much higher, it means that the allowed growth, the opening value is uplifted, or last year's closing value is uplifted by a higher figure. It's uplifted by 9%, which means that you've got more scope for growth within that scheme before you incur a significant, before you incur any pension input amounts. So you can see, despite the pensionable pay increasing by £2,500 in the 1995 scheme, there's still no growth. And that continues to be the case in the situation where CPI actually reduces to 3%. In both of those scenarios, the 1995 scheme actually attracts negative growth. And like I say, the reason for that is because the allowed uplift as a result of the CPI being at a higher rate for the previous year gives you effectively a negative pension input amount. What it doesn't do is give you a negative pension input amount for the 2015 scheme. So the 2015 scheme, like I say, your previous pension benefits are uplifted by CPI plus 1.5%. So CPI is 9%. That gives you a 10.5% uplift in your existing pension benefits. The allowed growth would be 9% from the previous year, so you've got a 1.5% uplift, which is effectively in excess of the available allowances already. What you've then got is the pensionable pay going into that, the amount that you've paid pension contributions on in the year, and that would give you a pension input amount within the 2015 scheme for 23-24, assuming a 9% pension CPI rate, of 30,693. Where CPI actually reduces to 3%, you can see that that reduces the pension input amount quite significantly, this time by about £5,000. And in both scenarios, the combined pension input amount across both of your schemes would actually be within a full £40,000 allowance. As I mentioned, if you've got negative pension input amounts, as we would do within the 1995 scheme, what you cannot do is actually use that either against the growth of the 2015 scheme, because the schemes are separate. You cannot have a negative pension input amount, it's just nil. So you can't utilise that against the 2015 scheme, and you can't actually carry it forward or carry it back to previous years. It's just treated as nil. There is no relief for that amount. Next slide, please, Louise. So, as I mentioned, the two scenarios that we've listed assume that your annual allowance isn't tapered. Now, if your taxable income does actually exceed £200,000, what would happen in that situation? Let's say we've got a hospital doctor who has private practice income and a property that was rented out, which tipped their total taxable earnings to £300,000. How does that affect things? Well, going back to the first example, so we've got 85,000 pensionable pay up to £90,000. Again, assuming that CPI is at 9% in September 2022, you can see that the growth is 40,353. Taxable income exceeds £200,000. So when we factor in the pension input amount of 40,353, the available annual allowance has decreased down to the minimum of £4,000. Now, assuming that there's no unused allowances from previous years, that would leave an excess of £36,353, which would be taxable at 45%, giving a tax charge of £16,359. And as I say, that would need to be paid to NHS pensions, not to NHS, to HMRC, sorry, by 31st of January the year after the end of the tax year. So in this case, 2022-23 would be payable by 31st of January 2024. What happens in with a salary sacrifice, as I touched on, is that your pensionable pay increases. So again, revisiting those previous examples, we've got pensionable pay in 2021-22 of 85,000. In 2022-23, they've still got the £5,000 pay rise, but that salary sacrifice scheme ends. They actually had a £5,000 reduction to their salary as a result of the salary sacrifice arrangement. So their pensionable pay jumps up even more significantly to £95,000. The impact of that, as you can see, is that the 2015 scheme growth is roughly the same, 31,092. It's gone up slightly because obviously you're pensioning more pension or more pensionable pay in that year. The 1995 scheme is where you see the more significant jump in pension input amounts. So that jumps up to £34,313. And like I say, it's because you've got that final salary link. Your final salary has jumped up by £10,000. Applying the fraction of 20 years out of 80 years service gives you a bigger pension than applying the fraction of 20 years out of 80 years to 85,000. It effectively gives you an extra £2,500 of annual pension contribution or annual pension entitlement, plus a £7,500 lump sum. Now, what that means is the pension input amounts across the two schemes all of a sudden jumps up from being just over £40,000 to £65,000. So the effect of that salary sacrifice arrangement is that you've effectively got £25,000 of extra pension input amount, which if taxed at 45% would give you an extra tax charge of £11,275. That comes from £5,000 salary sacrifice scheme ending. So you can see the impact that having an increase in pensionable pay, whether that be from a salary sacrifice ending, or alternatively, let's say the salary sacrifice scheme didn't end, but the pay rise was much higher as a result of an inflationary pay rise increase, that would have the same impact as what we've just set out here. So big pay rises do lead to quite significant pension input amounts and indeed quite eye-watering tax bills. And effectively what you're doing is paying tax on a pension that can be X number of years in the future, and you might potentially have to think about scheme pays elections to pay that, because you might not have the disposable income to be able to cover that. Next slide, please, Louise. So leading on from that, what are the options if you have a tax charge? Well, firstly, you can pay the tax charge personally via your self-assessment tax return. It's your responsibility to ensure that your tax return is completed accurately. What NHS pensions will do is provide you with a pension savings tax charge, pension savings statement, sorry, if your growth exceeds £40,000. You can request a pension savings statement and they should be able to calculate and provide you with one. They typically don't come through in a very timely fashion, and what you will have to do is make sure that you're happy with the figures on there. Accountants, financial advisors can help you with checking those statements or indeed calculating the positions yourself. And as I say, HMRC deem it your responsibility. So you need to make sure that your tax return is completed accurately. If it comes to light later down the line that actually you should have had a tax charge and it wasn't reported on your self-assessment tax return, there's potentially two implications. Firstly is obviously your tax return would have been incorrect, would have paid too little tax. HMRC are well within their rights at that point to charge you late payment interest on any additional tax charges that you report and pay after the 31st of January deadline. The second thing is linked to a scheme pays election. Now, a scheme pays election that has a filing deadline. The filing deadline is the 31st of July after the payment of the tax bill. So for 2022-23, as we talked about earlier, the tax would need to be paid by 31st of January 24. The scheme pays election would need to be with NHS pensions by 31st of July 2024. If you've not completed the scheme pays election and not reported the tax charge on your return, at a later point when you want to report a tax charge and complete the scheme pays election, NHS pensions are under no obligation to actually accept that scheme pays election. So you could potentially find yourself having to foot quite a significant tax bill personally if NHS pensions say we're not going to accept that election. If you do complete the scheme pays election, it's obviously well within the deadline, what happens is the NHS pension scheme will pay that tax charge to HMRC. They make quarterly payments to HMRC, so the earlier that you get those payments or get these scheme pays elections into NHS pensions, the better, because those quarterly payments don't tie up with your 31st of January tax payment deadline. If you, for example, submit a scheme pays election between the 1st of January and 31st of March, HMRC will receive the money from NHS pensions in May. Again, there's a period there where you've got a late payment, being 31st of January through to the date that NHS pensions make the payment in May. HMRC could come after you and say it's your responsibility, so therefore you've got to pay the tax, the interest on any late payment of tax at that point. If you complete scheme pays election, they are irrevocable, so you can't remove a scheme pays election. So this is why we say to always seek professional advice before doing so. You can change and make an amendment to a scheme pays election as long as it's within 4 years of making the election. I mentioned earlier about being charged interest. So interest is charged on the pension debit, and that is at 2.4% plus inflation. So where we've got inflation at the moment of 9.1%, you're looking at a 11.5% reduction in your pension benefits for this year, and that interest is rolled up, so it is cumulative. So you electing for a scheme pays or choosing a scheme pays election can be a very costly and very expensive thing to do. So again, seeking professional advice before doing so is well worthwhile. Benefits are permanently reduced in order to recoup the debt. NHS pensions don't pay the tax charge for free. It's your tax charge, it's your personal tax charge. You see the benefit of retirement in terms of getting a bigger pension. So they will seek to recoup the pension debt from you, and that will be via a reduction to your pension benefits upon retirement. A benefit of it, though, is lifetime allowance tax. So, and indeed income tax. Because your pension benefits are reduced, actually it serves to reduce your capital value for lifetime allowance. So if you are at or approaching the lifetime allowance limit, choosing for a scheme pays election isn't necessarily a bad thing, because it could potentially save you a lifetime allowance tax charge, and indeed save you a bit of income tax because you're not receiving such a significant pension upon retirement. 1920 was a bit of a one-off year. At the moment, there is currently no pension compensation scheme in place where you could elect for the NHS pension scheme to pay the tax charge on your behalf, and they wouldn't then reduce your benefits upon retirement, or there would be a compensation arrangement in place to recoup that for you at retirement. At the moment, there isn't anything. The BMA have been lobbying to try and get something in place because of the impact that increase in inflation has or is having on the NHS pension scheme. But at the moment, all we can say is assume that there isn't going to be anything, and if there is, then that's a benefit. Next slide, please. So, what else can you do? You can opt out of the pension scheme, and that's a very drastic thing to do. And I think you'd be hard pressed to find anyone that would advise you to opt out of the pension scheme. The NHS pension scheme is such a great pension scheme in terms of benefits, not only for pension entitlement, but for the other benefits that you receive: death in service, ill health, retirement, to name a few. What happens if you do opt out of the pension scheme? Well, pensionable pay is reduced for the period that you're out of the scheme. Obviously, you don't pay any pension contributions during that period. Your pension is linked to CPI, so it will only increase by CPI versus being an active member where it increases by CPI plus 1.5%, and indeed the amount that you're then pensioning. The other aspect of it is taxable pay. So you get tax relief fully on the pension contributions that you pay. Where you are no longer paying pension contributions, the taxable pay will be higher. So that can actually serve to give you a greater amount of tax throughout the course of the year. Your tax code may need to be adjusted depending on where you are at that rate, whether you're at that sort of £100,000 threshold where you start to lose some of your personal allowance. It can be more costly potentially opting out of the scheme. And indeed, tapering is actually a factor. So whilst you're out of the scheme, you do still benefit from having an annual allowance. You could potentially suffer tapering even whilst out of the scheme, regardless of if you've actually got any pension input amounts. If your taxable income does then exceed £240,000, you could still be tapered, and that can then affect you if you do opt back in and see significant growth when you then return to the pension scheme at a later date. And obviously the main one, pension benefits are reduced. When you're not pensioning the income, your pension benefits aren't increasing, where you are pensioning the income, obviously your pension benefits are increasing. So opting out is a very drastic decision, and like I say, you would absolutely need to speak to a professional before making that decision, and making a knee-jerk decision because having an annual allowance tax charge or potentially a looming annual allowance tax charge isn't the right thing to do. You need to make sure that you've obtained professional advice to make sure that you're making the right choice for you and you're going to have adequate resources come time. So one question that I often get asked is, should I reduce my sessions or hours? Am I doing too much work? Am I just working to pay more in tax? Well, reducing sessions or hours does help to reduce your taxable and pensionable pay. But if you are over 10 PAs, then reducing sessions doesn't actually have an impact on your pension. You can only pension up to 10 PAs, a whole time equivalent. So if you look to reduce additional PAs from say 12 down to 10, it doesn't actually have any impact on your pensionable pay. The only difference that would have would be to reduce your taxable income to £200,000 or to potentially below £200,000 to keep you within the tapering of the annual allowance and make sure that you're in receipt of the full £40,000. If you do reduce to under 10 PAs, then you pension less income, so less actually goes into the 2015 scheme, which everyone is now in as a result of as from the 1st of April 2022. But your 1995 scheme and 2008 scheme still is linked to a whole-time equivalent pensionable pay. So if you see a significant increase in pensionable pay, whether that be on a part-time or a whole-time basis, you could still be incurring quite significant pension input amounts and potentially quite significant tax charges. Next slide, please, Louise. So practical considerations. As I mentioned, you need to complete a scheme pays election by 31st of July 2024 for 2022-23. You may need to estimate it if the figures aren't available or if the figures haven't been calculated for you. As long as you've got a scheme pays election in place, you've got a 4-year window to submit a revised scheme pays election. So it just extends that window until you then get to that point in knowing exactly what those figures are. Opting out. If you want to opt out, you'd need to do that via your employer, and you may need to, there may be arrears that have to be processed. You can't opt out retrospectively, so you can't say from today that I wanted to opt out from 31st of March 2022. It would be, I want to opt out from today or from the end of the month or whenever it would be. It can't be done retrospectively. It may not be processed immediately, in which case there could be adjustments that are processed through your pay. And that may stem out or may spread over a tax year. You're taxed on the year that the income is received, so just bear that in mind. Retirement planning. If you choose to opt out, what are you going to do instead with regards to saving for your retirement? Again, this comes back to making sure that you sought professional advice before going down this route. It's a very topical conversation that we seem to be having quite frequently. It's something that you do need to make sure that you are seeking professional advice on, because without it, you could potentially leave yourself short in retirement, and that's not what anybody wants or needs. Next slide, please, Louise. And there are mine and Louise's contact details. So if you do have any questions, then please feel free to get in touch, and I will now hand you over to my glamorous assistant, Simon.
It's a very long time since I've been called glamorous. If you've got any questions following George's presentation, or indeed any questions you've got whilst I'm talking, there is a chat box somewhere on your screens. I think that Louise is currently monitoring that. So, and we should have a few minutes for questions at the end. So if you do have any burning questions, please feel free to type them whilst I'm talking, and we'll get to them in due course. What I'm going to do is, for the next few minutes, I'm going to have a brief recap of the 2015 pension scheme benefits. Since the McLeod judgment has come through, everybody effectively transitioned into the 2015 scheme on the 1st of April this year. The benefits are slightly different, both in what they provide and how they're accrued, so it's important just to be fully aware of what you're paying for. Excuse me. I'm going to go through a couple of worked examples, some scheme pays elections. Some of the annual allowance tax charges do look quite scary, and it's important to see what they actually mean on a practical basis for what they actually mean to your pension when you retire. I'm going to briefly touch the lifetime allowance tax charge, because that is another pressing issue we have for many of our clients, and the impact a scheme pays election has on any lifetime allowance charge you may have. If you did elect to leave the scheme, George spoke about losing benefits, and I'm going to touch on exactly what those benefits are that are lost. And the default is absolutely to stay in the pension scheme, but if you were to leave, some of the options that are available for you. So on the next slide is just highlighting what the basic benefits of the pension scheme are. So most people will have been members into the 1995 pension scheme prior to switching across to the new scheme in April. The 1995 scheme was a final salary pension scheme based upon years of service, and you accrued benefits on an 80th basis. So you accrued 1/80th of your final salary in principle for each complete year you worked. Although it never worked entirely, the principle is you could work 40 years within the NHS and retire on a pension of 50% of your highest pre-retirement earnings. The 1995 scheme also had an automatic tax-free lump sum, which was 3 times the pension. The 2015 scheme works on a different basis. It's what's called a CARE scheme, which is a career averaged revalued earnings scheme. Superficially, it actually accrues benefits quicker than the old scheme. It actually works effectively on a 54th basis rather than an 80th basis. On a percentage basis, you accrue pension benefits of 1.85% each year of your pensionable earnings. So if you've got pensionable earnings of £100,000, then you've accrued £1,850 worth of pension benefits in that 1 year in isolation. So superficially, it appears to be more generous than the older scheme. It isn't for 2 reasons. Firstly, the new scheme has no automatic tax-free cash lump sum. You can take a tax-free cash lump sum out of the scheme, but to do so, you must take away, you lose part of the pension you would otherwise receive. And if you wish to get an equivalent lump sum out of the new scheme compared to the old, then the benefits occur at broadly the same level. The biggest issue is retirement age. The new scheme is written to have a normal retirement age with a state pension. So if you're retiring today, state pension is 65. That's increasing to 67 from 2028. It's increasing to 68 from 2044. There's currently a consultation to bring that 68 age back down to people retiring post 2039. And because people are living longer, there is an expectation that state pensions will eventually be payable broadly from age 70. That's sort of the long-term expectations. You can draw benefits early, but to do so, you do suffer a reduction. There's an actuarial reduction. It's a mathematical stretching of your pension scheme benefits to account for the fact you're retiring sooner from the scheme. The pension scheme, both schemes, the old scheme and the new scheme, both provide death in service benefits of twice your annual superannual earnings, ill health retirement benefits. Normally, if you work in hospital service, you'll get 6 months full pay, 6 months half pay. At the end of that 12 months, your contract is normally ceased, and at that point, you can claim for an ill health pension. It works on one of 2 bases. So a tier 1 ill health retirement pension would be payable if you are unable to work again in your normal chosen occupation. So whatever your speciality is in hospital service, if you can't undertake that work, a tier 1 pension would be paid. A tier 1 pension would just pay whatever pension benefits you've already accrued to date early. So there's no enhancements. You just don't have the penalties for retiring sooner. The alternative is a tier 2 ill health retirement pension. That is payable if you're unable to undertake your usual occupation and you cannot undertake any paid occupation of similar duration. So if you're a full-time consultant working 10 PAs, if you couldn't undertake any paid employment, irrespective of what that employment is, then you would potentially get a tier 2 pension. That accrues benefits on 100% of everything pension benefits you've accrued to date, plus 50% of the pension that you would have accrued had you worked through till normal retirement age, so 67, 68. In both circumstances, to claim the ill health pension, any issues you have, any illnesses or ill health you have must be permanent in nature. So there's absolutely no guarantee that pension benefits would be ill health retirement benefits would be paid. That's why it's important to have things like income protection in place just in case they don't pay. Finally, the 2015 scheme also provides spouse and pension benefits. A pension for a spouse of broadly a third of your own retirement pension on ill health grounds, 2 children, up to a third in total. So a total pension could be payable of 2/3 your notional ill health retirement pension. Spouse pensions paid through life. The children's pension is paid till they reach age 23. That is marginally less generous than the old 1995 scheme. Moving on to the next slide, what I'm going to do now is look at a couple of worked examples for a scheme pays election. As George said, scheme pays elections, it's a payment by the scheme to HMRC to pay that part of your tax bill caused by the annual allowance charge. It's treated as a loan, and with all loans, it's subject to interest. So the interest charged by the scheme has differed over time, but currently it's 2.4% plus CPI. CPI starts 6 months after the scheme pays election cutoff date. So if you were to have a tax charge for the current tax year 22-23, the scheme pays election must be in by the 31st of July 2024, and interest starts being charged from the 1st of January 2025. Now that is potentially important because one of the issues that you may end up having some sort of annual allowance issue this year is the very heightened level of inflation, as George referred to earlier. There is hope that whilst your pensions will have increased significantly because of that inflation this year, if you do use a scheme pays election, you won't have that very heightened level of interest levied because one hopes inflation will have dropped down to more normal levels by then. Then at retirement, your pension is reduced by a factor to recoup the money that you owe the pension scheme, and that's the original sum they paid for the tax charge plus the interest charge. Now that factor differs depending upon the age when you make the election and the age when you retire. I'll come back onto those in a moment. It is fair to say that the scheme pays elections are more expensive the younger you are. So younger members, for the same amount of tax charge, do have it does a greater ultimate impact upon pensions. And as George said, once you've made that election, you can't change your mind, but any election is done on an annual basis. So if you did have an annual scheme pays issue, then you can choose to pay it or not pay it year on year. So working through to our first example, I'm going to use probably quite a large annual allowance tax charge. In this instance, it's just over £23,000. In truth, liability is likely to be less than that unless you've had a very significant increase in income. Salary sacrifice has caused issues, as George suggested earlier. The other thing is that obviously there is a lot of concern in the public sector at the moment regarding very low pay awards. If you were to get a pay award anything approaching inflation, then that would have an automatic impact upon the annual allowance charge just because of the increase in 1995 benefits. The two worked examples I've got both assume retirement age at 60, both from existing 1995 scheme benefits and 2015 benefits. There is no compunction to draw both at the same time. Normal retirement age in the old scheme is 60, and for most people it is sensible drawing those benefits at 60, even if you subsequently return to work via 24-hour retirement. You can take 2015 benefits at the same point. If you were to do so, they are reduced because of the reduction because you're retiring early, or you can take them to a later date. So this is for example purposes only. So moving on to the first example. Excuse me. What we've got here is a 45-year-old member that has a scheme pays election caused by the annual allowance tax charge. Part of that annual allowance tax charge is caused by the old scheme and part by the new. So the calculation works like this. So in this instance, the 1995 scheme has caused a tax liability of £10,678. As I said, that's reduced, that's divided by a factor. In this instance, if you happen to be 45 and you retire at 60, that factor is 17.3. It does appear somewhat arbitrary, and there are several of these factors which are given to us. So they're decided by the NHS pension scheme actuaries. So the immediate reduction in pension benefits caused by using the scheme pays election reduces the pension in this instance by £617 per annum. To that, we need to add the interest that's payable. Now, I've deliberately not added CPI into this, A, because we don't know what CPI is going to be for the next 15 years. Secondly, there is some hope at least that your pension will at least increase by CPI each year. So just taking the 2.4% in addition to CPI hopefully gives a true value for the actual cost of scheme pays. So 14 years worth of interest, 14 years because you don't start paying interest in the first year. That means that the 1995 scheme costs have reduced your pension by £860 per annum. Because it's the 1995 scheme, there's an automatic tax-free lump sum. It's reduced the lump sum by just over £2,500. 2015 benefits, premise is exactly the same. The factors differ. So £12,535 worth of annual allowance tax charge paid by the scheme out of the 2015 arrangement, divided by 12.4. The factor used differs, reduces the pension immediately by just over £1,000. 14 years worth of interest causes the pension to be reduced by £1,400 per year. Add those two together, the true cost of pension for that £23,000 tax bill that the scheme's paid for you is about £2,269, plus there's a loss of the lump sum benefits from the 1995 scheme of £2,580. This affects members' pensions only, it doesn't affect spouse or dependents' benefits. So if you do use scheme pays elections, if spouse or dependents were to claim, they will get the percentage of the original amount, not the reduced amount. So moving on to the next example, I'm using exactly the same figures. The only difference is the differing age of the member. In this instance, the member's 55, so 10 years older. The calculations are the same. The factors differ. For the 1995 scheme, the factor is 21.7. We only need to add 4 years worth of interest on, which reduces the pension by £541 and the lump sum by 3 times that. Under the 2015 scheme, factor once again is reduced, so the original loss of pension is less and less interest to add, so the total reduction is £872. So for a 55-year-old member, you can see that the total cost of the scheme pays election is significantly less. So as we can see from the next slide, scheme pays elections are cheaper the closer you are to retirement. In the example used, the total reduction, or the total reduction in pension was £856 less for the older member compared to the younger. The lump sum reduction was £957 less. So exactly the same tax charge makes a 38% difference in the actual cost to your eventual pension benefits. A couple of things that are important to remember. Those calculations ignore inflation. So the actual interest is charged at CPI plus 2.4%. I've left the CPI out of the calculation to try and give a true reflection of the cost when you reach retirement. Secondly, it isn't possible at outset to accurately calculate what the scheme pays election will ultimately cost. CPI is unknown. Whether all of your 1995 benefits continue to increase by CPI exactly the same rate, bearing in mind it still has a final salary link, is unknown. And the interest rate over and above CPI has been subject to change by the scheme. It started off at 3.1%, it reduced to 2.8, it's currently 2.4, but they have been changing the rates by which it's charged. So if we move on to the next slide, what we'll see is I'm going to touch briefly on the lifetime allowance, because this is the other big issue that many clients come to me wishing to discuss. The lifetime allowance, unlike the annual allowance, which is how much you can notionally pay into your pension in any 12-month scheme year, The lifetime allowance is the total amount of pension benefit you can accrue from all sources during your lifetime. Unlike the annual allowance, it causes no tax issues to the point of retirement. The current allowance is £1,073,100. It was fixed at £1 million 2 or 3 tax years ago. Like many allowances, it's now been frozen for a minimum of 5 years, so this is likely to stay the same at least for the next 4 years. And this is the amount of pension benefit you can accrue if you have no form of protection in place. If you have kept an eye on lifetime allowance, it was introduced in 2006, and the actual figure has varied significantly. It's been as low as £1 million. It's been as high as £1.8 million in 2012. And every time since 2012, when the government has reduced the figure, they have put in place certain protections which you could apply to HMRC, asking for a higher lifetime allowance. All of those, with the exception of one, have now expired. The only one available to apply for now is called IP16. That allows you to protect an allowance of more than £1 million if you had already accrued a pension that exceeded that as of the 31st of March 2016. If you feel you are in that situation, then it would be useful to, it'd be sensible to have a chat with myself or Louise or George just to discuss what your options will be. So what does that allowance mean in NHS terms? Well, if you'd only accrued pension benefits in the 1995 scheme, it equates to an NHS pension of about £46,500. If you'd only accrued pension benefits from the 2015 scheme, it's £53,500. You will undoubtedly have accrued some benefits from each. In addition, you may have personal pensions, which also add to the lifetime allowance, but it gives a broad indication of when it becomes an issue. So moving on to the next slide, how does that work with respect to the scheme pays election? Well, if you have exceeded the lifetime allowance, it's subject to a tax charge of 25%. Unlike the annual allowance, there's no option to pay it directly. It's automatically paid by the scheme. So in this example, if it exceeded the lifetime allowance by £100,000, there's a lifetime allowance tax charge of 25% of that. So the scheme has to pay £25,000 tax on your behalf to HMRC. Just like the annual allowance, if you've used the scheme pays election, they claw back that money over the remainder of your life whilst you're drawing pension by reducing your benefits by a factor. The factor once again differs on exactly which age you retire, but if you retire at age 60 from the 1995 scheme, the factor used is 20.6, so £25,000 tax charge divided by 20.6 is an annual reduction in your pension of £1,214 each year. Easiest way to remember it, bearing in mind you would have paid tax on that £1,200, it nets to about £60 a month. So every £100,000 you are over the allowance reduces your net pension by about £60 per month when you eventually retire. Now, the lifetime allowance charge is levied on the net pension you receive. If you use scheme pays election, that has the impact, as George said, of reducing the eventual pension you receive. That has an impact of reducing the impact of the lifetime allowance charge. So if at retirement, you've got a scheme pays charge, which has reduced your pension by £3,000 per annum, that reduces your pension fund for lifetime allowance purposes by £69,000. 25% of that would have been taxable. So because that's been reduced, the tax liability for the lifetime allowance charge is reduced by £17,250. That has the impact of reducing the lifetime allowance tax charge on your pension by £837 per annum. What that means practically is if you are likely to suffer or do suffer lifetime allowance tax charge issues because you have already exceeded the allowance or you are very likely to, and you have scheme pays election issues or you've got annual allowance issues, in the vast majority of circumstances, it makes sense to use the scheme pays election. The alternative is potentially paying quite a large annual allowance tax charge directly. That has the impact of maintaining the integrity of your pension fund at retirement. All that ultimately does is it causes you a larger lifetime allowance charge. which is counterproductive. So I said there's relatively few circumstances where if you're already exceeding the lifetime allowance and you've got an annual allowance issue as well, that a scheme pays election isn't the sensible option. So if we can move to the next slide, what George said was quite right about retaining membership of the scheme. There's very few circumstances where it would be sensible to leave the pension scheme, particularly working on a salaried basis, because you pay your employer contributions. Sorry, you pay your employee contributions to the pension scheme, but they are uplifted by employer contributions as well. I do know one or two trusts where if you do opt out, the employers are still rebating certain contributions that they otherwise would pay into the pension, but I think that's not the case with most hospitals in particular now. So if you did elect to leave, what does happen? The first immediate thing that happens is your death in service benefits are lost. So that twice annual salary, which is paid to your dependents in the event of your death, are immediately lost. On that note, if you are married or have a legal spouse, those death in service benefits would automatically be paid to them. If you don't, if you're single, it would make sense to complete what's called a DB2 declaration. It's advising the pension scheme who you would like to receive those benefits in the event of your death. However, if you did leave the scheme and you did lose benefits, it isn't an insurmountable issue. In isolation, it wouldn't be a reason to stay in the scheme unless you're in ill health and couldn't get life cover elsewhere. £200,000 worth of life cover for a 45-year-old non-smoker who's in reasonably good health for 15 years to replace that cover is about £24 a month. That same cover for 5 years for a 55-year-old is about £41 per month. Once again, that assumes you don't smoke and that assumes you're in good health. If you do have health issues, it's very important to take personal advice as to whether it would be a good idea to leave, because you may not be able to replace those benefits. If you do leave the scheme, pension continues to increase annually by CPI only, but you lose that 1.5% uplift. The final salary link to the 1995 scheme benefits is lost if you are out of the scheme for more than 5 years. So whilst you're in the scheme, increments in pensionable income not only impact your 2015 benefits, they also impact your 1995 benefits, which is why those increases you may have in salary has an impact upon the annual allowance charge, because it has this uplift on your 1995 pension scheme. If you're out of the scheme for 5 years or longer, that link is lost and your 1995 benefits will just continue to increase by CPI with no linking to further increases in salary. Ill health retirement benefits are retained. You remember I talked about that tier 1, tier 2 ill health retirement pension. They are retained, however, they may become harder to claim. They certainly erode in time. As George said earlier, obviously if you're not a member of the pension scheme, you're not accruing pension scheme benefits. That's true of ill health benefits as well. It's also true of spouse and dependents benefits. Although the benefits are retained, they won't continue going up if you're not actively contributing to the scheme. So if you're out of the scheme and intend staying out of the scheme, then it's important to make sure things like life cover, critical illness, income protection, and those types of private policies are sufficient to account for any shortfall in the NHS. The NHS benefits in isolation probably aren't sufficient anyway, so I would always suggest you take advice to make sure that you have adequate cover in place, whether you are in or out of the scheme. If we can move to the next slide, if you do look at leaving the scheme, what are the alternatives? You obviously had an uplift in income because you're no longer paying pension contributions. It's almost certainly not going to be sensible to make private pension contributions to yourselves as a member. The principal reason for leaving the scheme is because you've got some sort of tax problem caused by annual or lifetime allowance. It's exactly the same if you make private pension contributions. However, if you do have lower earning spouses, it is quite often sensible to put additional pension benefits in your spouse names. It's assuming they don't have the same issues you've got with the NHS. You can pension up to 100% of earnings up to a total contribution annually of £40,000 per annum. And certainly post-retirement, if you've got one higher earning partner and one much lower earning partner, it doesn't make sense aggregating all income post-retirement with one partner potentially paying quite significant higher rate tax liability post-retirement when you've got a spouse that earns little or nothing and may not even be using their full basic rate allowance. If you've got a non-earning spouse, you can pay up to £3,600 per annum gross into pensions under stakeholder rules. They're exactly the same rules that allow you to make pension contributions for children. Next best alternative for many people would be to fund ISAs. Equity ISAs and cash ISAs allow have an allowance of £20,000 per annum. Although there's no tax relief for making payments into ISA, they grow in a tax efficient environment and there's no tax liability when you take money out. Alternatively, certainly for higher rate taxpayers, it's certainly worth considering things like venture capital trusts. Now, they are higher risk investments. If the government is ever going to provide tax relief, it's important to think why they might be doing that. In the manner of pensions, they wish people to fund for their own retirement. For venture capital trusts, they wish people to invest in potentially higher risk investments than otherwise they may be comfortable with. Investments into VCTs can start from as little as £5,000 as a single payment. They are higher risk investments, but they do receive 30% tax relief up front. So if you invest £10,000, you get an immediate tax reduction of £3,000, and that's retained as long as you keep that in place for a full 5 years. Although they are higher risk investments, they have become increasingly mainstream, and they can be built into most people's financial plan and their investment portfolios, assuming sort of a reasonable level of assets. If that's the only £10,000 you've got, I certainly wouldn't put it in a VCT, but as part of a wider plan, they really work quite well. If you would like any further information from me, the next slide's just got my contact details, and I think we hopefully have a minute or two for questions.
We do, thank you, Simon. We've had a few questions come through, which George has kindly gone through and already answered them, so you should have had a notification if you did ask the question, but they may be useful for others watching today, so I will just go through them quickly, but we won't take up too much more of your time. So one of the first questions asked was whether payment for extra shifts contributes to pensionable pay. So it will depend whether you are already a full-time employee or a hospital doctor working 10 PAs. If you are already full-time, then those extra shifts will not be pensionable, because you can only pension up to full-time equivalent or up to 10 PAs. If you are part-time and working lower, then yes, they would be up to that full-time level. A question was raised about paying added years, and if you opt out, do you still accrue for the added years, and is it worth backing out? If you have got added years, and you opt out, your service is frozen, so whatever you've accrued to date will remain. You won't lose it, but you cannot restart it. I think if you opt back in within 12 months, potentially you can, but if it's a longer period, you can't restart the added years. Now, it's likely that the added years could be causing you a problem or increasing the problem, because the nature of added years contracts are that it's increasing your service at a quicker rate than it would otherwise. So again, taking financial advice, looking at what your position is and the impact of that added years contract will determine your next steps, whether it's worth backing out. Reflect back to what we've spoken about today. You have the scheme pays option, you might not have a tax charge. It's very specific circumstances. Can an old private pension be moved into your NHS pension? Yes, you can. There is information online about it. So if anyone would like to know a bit more, please do let us know and we can send you a link if needed. Question raised about interest. Does the interest on the scheme pays fluctuate based on annual CPI, or is it fixed? No, it's not fixed. It does fluctuate year on year based on any given year's inflation rate. Can we clarify that clinical excellence awards are not pensionable? It depends. Any new local awards are not pensionable, but any nationals of gold, silver, bronze do remain pensionable. If you had existing awards in place before they slightly tweaked the rules, then they do remain pensionable. So it will depend whether it's local or national and when it was initially awarded. And then we've just had one extra question come through. Can we explain a little bit more about McLeod and what that means? We could talk about McLeod for hours, but to give a quick overview, it was deemed that the introduction of the 2015 scheme and the fact that some members had to move in and some didn't was age discriminatory. So the government lost that ruling. So to remove the discrimination, they said, okay, we will move everyone into the 2015 scheme from April 2022. And in that 7-year window from April 2015 to March 2022, now for some of you it might be slightly less because you have transitioned in at a later date, your pension benefits will revert back into your old scheme, your legacy scheme, so the 1995 scheme or the 2008 scheme. So your benefits will be recalculated. NHS pensions have until October 2023 to do this, although it's probably not going to happen by then. So they will recalculate your benefits as if you had remained in the 95 or the 2008 scheme, and your 2015 scheme benefits will restart at April 2022. Now, that could mean you have slightly lower growth because, as Simon mentioned, the 2015 scheme accrues at a quicker rate, and therefore the pension growth will be slightly quicker. What we don't know is actually how the administration of all of this is going to work in terms of recalculating pension benefits and how automatic that will happen. So all we can do is wait, watch and wait. There's a couple of other questions. Is there an annual salary point in which you are likely to start having these pension issues? No. If you are quite early on in your career, then potentially you are less likely. But it's really, with the 95 scheme, potentially, if you have that final salary link, it's the jump from one year to the next. So you could go from maybe 25 to 30 or 25 to 35, and that could still give you a problem, but you may have unused relief from earlier years. So I don't think there is any particular salary point, unless George or Simon want to correct me in that respect.
I think the only thing that I would say there is if your salary is static and not changing, so not going to incur quite significant growth within the 95 or 2008 scheme, the 2015 scheme, there is kind of a threshold. It's around about 120 to 130,000 pounds pensionable pay, and that's just because your pension input amount within the 2015 scheme alone is very close to that £40,000 allowance. So if you're at that sort of threshold, then the chances are you're probably going to start incurring annual allowance tax charges on a regular annual basis.
Thanks, George. We've just had one more come in, so we'll do that one quickly. If there are any other questions, we have the contact details, so we will come back to you separately. In 2015 career average start from the date of joining the pension initially, or from 2013 after McLeod. So in the 2015 scheme, it will start from 2022. It's being wiped clean from 2022. So the first year of benefits that you will build up is in the 2015 scheme for the year April 22 to March 2023. If you joined the pension potentially in 2013, which maybe is what you're suggesting, You would have gone into the 2008 scheme at that point because the 2015 scheme wasn't introduced. So you would have some extra benefits now in the 2008 scheme. So your career average will start from April 2022.
Yeah. And equally, if you joined in 2016 or after 2015, you would just be in the 2015 scheme, so there wouldn't be that transition. You've not got a legacy scheme to go back to.
Yeah, because you didn't have any age discrimination impact, so it wouldn't apply to you. So I think that is all of the questions. So thank you from myself, George, and Simon. Hopefully it's been useful. If you have any questions, please do get in contact with either one of the three of us, and we'd be pleased to help you. Thank you and good evening.
Thank you.
Thank you.